Hi everybody. In this video, I'll discuss interest rate parity, which is part of Gerber chapter 10. Earlier in the chapter, we discussed and defined the concept of interest rate arbitrage, which, like any kind of arbitrage, means taking advantage of a difference in the price of a good or an asset in two separate markets, buying it in the low price market, selling it in the high price market. Any sort of arbitrage has the effect of bringing prices closer together. So, for example, when lots of people rush to buy the good in the low price market, it raises demand and therefore price. When lots of people are trying to unload, sell the good in the higher price market, the increase in supply pushes down price. So interest rate arbitrage is no different from other types of arbitrage. It pushes prices, which are interest rates in this case, closer together. This idea is known as interest rate parity. Expressed more formally, if you have a fixed exchange rate and perfect capital mobility, which means capital is allowed to freely flow in and out of your economy, it has to be the case that the domestic interest rate is equal to the foreign interest rate, because if it is not, as shown in my little notation here, which actually follows the Gerber chapter, say for example, if the domestic interest rate is higher than the foreign interest rate, that will induce capital to flow in, and the increase in credit will put downward pressure on interest rates until the domestic interest rate falls to be equal to foreign interest rate. So in our loanable funds market model from ManQ chapter 19, in the loanable funds market, we would show that graphically by a decrease in demand, which would lower interest rates. But you can also think of it as an increase in the supply of credit. We've discussed several times that capital flows are the most important determinant of exchange rates, especially in the short run. We've also talked about the determinants of capital flows multiple times, and I've given you a list of 4 things from ManQ chapter 18 that influence net capital flow. Interest rates, both the domestic and the foreign interest rate. Number 2 was the third factor was political and economic stability, and the fourth was government regulations. But there's another factor that influences capital flows that we haven't yet discussed, and that's expectations about future exchange rates. If you're considering the decision of whether to buy a domestic bond or a foreign bond, you take into account not only the rate of return that you would receive on those bonds, but you also have to take into account possible future changes in the exchange rate. If you buy a bond from a foreign country, denominated in a foreign currency, and that currency depreciates, you'll get less profit once you convert those earnings back into dollars if the foreign currency has depreciated. So another application of interest rate parity is this. It essentially tells us that when you see differences in interest rates between countries, you can infer what the market expects to happen to the exchange rate of that currency. And that's expressed here mathematically. So the difference in interest rates is equal to the expected change in the value of the foreign currency. So we, in chapter 18 and 19 ManQ, always set up exchange rates with the domestic currency on the bottom. Unfortunately, the Gerber chapter does the opposite, and I just wanted to follow the notation in the Gerber chapter for this part of the book. So this tells you the expected appreciation or depreciation in the value of the foreign currency. So let me explain this term briefly. It's just a percent change. It is the difference over the initial value. ET is the current exchange rate, the initial value. ET plus 1 is the exchange rate people expect one time period into the future. Here I've just simply rearranged the equation to say the domestic interest rate is equal to the foreign interest rate plus or minus the expected appreciation or depreciation in the foreign currency. An example will help illustrate this concept. Suppose you're deciding whether or not to buy a US bond, which would give you a 2% yield, versus a UK bond, which would give you a 5% yield. Which one do you prefer? Well, clearly looking at just the interest rates, the UK bond is more profitable. It gives you a 5% yield versus a 2% yield. But your ultimate profits or gains will also depend on what happens to the pound in the future when you get the earnings from the bond and you go to convert those back into dollars. So which bond should you hold in this situation? It also depends on whether you expect the pound to appreciate or depreciate. If we sort of plugged these numbers into the equation here, we would see that the equation essentially infers that the market widely expects the pound to depreciate by 3%. So this is stated in the bottom of the notes. Interest rate parity implies that, for example, if a 1-year US interest rate is 3% lower than the interest rate on a 1-year debt instrument in the UK, it has to be the case that financial investors are, on average, expecting the dollar to appreciate by 3%, or in other words, the pound to depreciate 3% versus the dollar over the coming year. If that wasn't the case, nobody would be willing to hold US bonds given their lower interest rate. So I have a couple other scenarios here, just going through a couple examples. Basically, you just need to plug in these numbers into this equation, where this is the expected appreciation or depreciation of the foreign currency. So if, for example, you expected the pound to depreciate 4%, that makes the US bond more attractive. The net rate of return will be higher for the US bond. But if you expect the pound to appreciate, say for example 5%, the UK bond is definitely more attractive. In fact, the UK bond is the most attractive as long as it depreciates by less than 3%. So say the UK pound depreciates by, or you expect the UK pound, the Great British pound, to depreciate by 2.9%. You're still going to have a higher rate of return by buying the UK bond in the end. As always, we are ignoring transaction cost, but in the real world, there could definitely be some transaction cost get in the way. Okay, last key point here, or last sub-bullet point note, it says, if financial investors expect exchange rates to stay the same, then they'll essentially require the same nominal interest rate in both countries. I wanted to show at least just one real-world example of this. So this is the US and the UK interest rate. So essentially, over this time period, times when the UK interest rate is higher, essentially the market is expecting the pound to depreciate. Summing up interest rate parity. As we just showed and discussed, using the concept of interest rate parity, you can infer what international financial markets expect to happen to currencies in terms of appreciation or depreciation. Interest rate parity is an influence on exchange rates. When interest rates differences exist between countries, capital will flow in and out of those countries, affecting the demand for a currency and therefore affecting exchange rates. So this is one additional factor that was not included in the supply and demand model of exchange rates that we discussed in ManQ chapter 19. But it is a factor. Last key point. Expectations of the future value of an exchange rate can have a dramatic and self-fulfilling impact on a country's currency. Essentially, expectations can, in many cases in economics, can be self-fulfilling, and this is one great example. So if everyone expects a currency to appreciate, you get more demand for that currency, and the value of the currency goes up. A good real-world example of that is safe haven demand. And right now, because Switzerland is often seen as the Swiss currency is often seen as a safe haven currency, because of the coronavirus right now, there's an increased demand for that currency, and the central bank is actually intervening to prevent the Swiss franc from appreciating. But safe haven demand is kind of an example for this. Everyone rushes to buy a currency because they expect it to be stable and safe and maintain its value. If the international market widely expects a currency to depreciate, there'll be less demand for that currency and more supply. Everybody will be trying to sell it and offload it. And that essentially makes the currency depreciate. This is the story of a currency crisis, more or less. And we will discuss that in Gerber chapter 12 soon.